Hey guys, Reese here. Welcome back to my channel. Today I want to dive right into it and take a look at all the doom and gloom surrounding the real estate market and specifically the mortgage market that we're seeing in the news. With unemployment still skyrocketing and the virus only now starting to flatten, hopefully, many of you are probably continually checking the news, continually looking at stimulus updates, and it's hard to follow the news without also seeing the upcoming mortgage crisis. I'm seeing lots of headlines saying the upcoming mortgage crisis could be as bad or worse than 2008. Banks will go under without the Fed's bailout. And today I want to look at some of the concerns surrounding the mortgage market and why many news outlets are saying there's going to be a mortgage crisis. And I hope today to shed some light on those 4 top concerns in the market and share my opinion on them, as well as I'd love to get some of your opinions in the comments below. So if that sounds good, guys, please leave a like on this video, please subscribe to my channel, and as we go throughout this video, please leave your comments below on what you think is going to happen in the market going forward. So the first concern we see in the mortgage market is the wave of missed payments that's going to be happening now and the upcoming few months due to loan forbearance. The CARES Act allows all borrowers with federally backed mortgages to apply for loan forbearance by contacting their servicer and stopping payments for up to 180 days. And then if you're still in a situation where the virus has impacted you, once 6 months has gone by, you can apply for another 180 days after that. And the issue with this is that the CARES Act also states that servicers cannot require documentation or proof that you actually have been affected by the virus. Now, these federally backed mortgages currently make up 62% of first lien position loans in the housing market. And unfortunately, as of April 17th, we see 5.5% of all federally backed loans have already applied for forbearance. That comes to 2.9 million loans have paused payments for 180 days. However, that's not really the main issue with these missed payments. The main issue is that mortgage servicers still have to make these principal and interest payments on your behalf to the investors, insurance companies, bondholders who bought those mortgage-backed securities. And at current levels, as of April 17th, that equates to $2.3 billion a month that mortgage servicers are on the hook for and still need to provide to those investors. Now, with mortgage forbearance, usually at the end of 6 months, you'd be required to make those payments back in full. However, the CARES Act allows those payments to be either tacked on to the end of your mortgage, or you can require a loan modification and spread those missed payments out over the rest of the term of your mortgage. And in both cases, that means the payments that your loan servicer forwarded on to investors, the servicer won't recoup that money until most likely, in most cases, the end of your mortgage. Now, the issue with this is that all but the largest loan servicers are going to not have the money to front that capital to investors. And these services are going to quickly fail on these payments to investors unless the government steps in and provides backing for these payments they're fronting on the borrower's behalf. Now, the second concern is that some of these borrowers will still be unqualified at the end of the year when applying for a loan modification. Like we just talked about, with forbearance under the CARES Act, payments will be spread out through the remaining term of the loan with a loan modification or tacked onto the end of the existing loan. However, what happens if that borrower who lost their job due to the virus still doesn't have a job at the end of the year term? And now a loan modification, which normally requires a new application and new screening on the borrower, they still can't qualify. So my concern on this part is whether or not borrowers will need to re-qualify for the loans. Now, if they don't need to re-qualify, then I don't see too much of an issue with this. However, if they do need to re-qualify, there may be potentially a lot of loans being called due or borrowers forced to sell their home because they can no longer qualify for that mortgage. The third concern I see is the availability of new loans. Now, I see this causing more of a decline in the real estate market and not too big of an effect on the mortgage market. However, I want to point this out here as it does highlight some important changes happening in the mortgage market. We've already seen recently that Chase has increased their qualifying standards to a 700 credit score and are no longer accepting less than 20% down on purchases. This could lead to as much as a 20% drop in qualified buyers searching for homes. Now, when it comes to Chase, I'm not too concerned because beforehand, they already had a 680 credit score minimum and a 15% down minimum. So it's not too big of a change. My concern comes from what happens when other banks start to follow suit. There are many banks currently still accepting 5% down payments or below 600 credit scores. However, if other banks start to follow Chase's guidance and raise their qualifying standards as well, that's going to continually reduce the buyer pool. Now, in addition to this, as we stated earlier, loan servicers are having an issue with cash flow. And now loan servicers also underwrite new mortgages. However, with the market uncertainty and 5.5% of federally backed mortgages already in forbearance, it's highly unlikely loan servicers are going to want to take on new mortgages at this point in time, where there's additional risk that those loans will go into forbearance as well, adding to the servicer's cash constraints. This lack of mortgage availability and qualified buyers in the real estate market could put strong downward pressure on prices, along with some owners being forced to sell their property due to issues with loan modifications and forbearance at the end of this term, causing a strong downward spiral on single-family home prices. Now, I'm not 100% convinced that 2 to 4 unit properties will experience too much of a price dip, as a lot of those investors already put more than 20% down and already have good credit scores. However, I'd love to hear your comments below on what you think is going to happen to that market. In addition, as people start to sell their homes if they come into issues in the single family market, those people selling their homes will still need a place to live and will most likely rent in the B to C class market, which will cause strong demand in the B to C class rental market, perhaps even pushing rental rates higher. Now, I could see a little bit of an issue in the A class market as people might begin to downgrade. But once again, I'd love to hear your comments on this below. A third concern surrounding the mortgage market today is the surge in margin calls that are happening right now. Now, I'll be honest, I had to do a little bit of research on this myself because I wasn't too sure how this affected the industry. The Fed's efforts to shore up the mortgage-backed securities market has actually unintentionally hurt lenders who have hedged against the drop in mortgage-backed securities. The Fed's mass buying of mortgage-backed securities has actually caused a rally in prices, so interest rates have been going down. And this has led to brokers calling margin positions due on lenders. In short, when a lender makes a mortgage to a borrower, they will often resell them to the mortgage-backed securities market. However, they will sometimes keep them on their balance sheet for a little while. And when they do this, they'll also short the mortgage-backed securities to hedge against if interest rates go up. Because if interest rates go up, the value of that mortgage will be less when they go to resell them to the market because their interest rate is lower. However, because the Fed is buying so many of these mortgage-backed securities, it's actually lowering the price. And because of this, brokers are closing their margin positions, causing banks large losses. And currently, these margin calls, as they're called, are at unprecedented levels similar to that of 2008. All of these happening in addition with the forbearance and the fronting of payments is really causing a crimp on cash flow to servicers and lenders. And finally, my last concern is the inflation of home prices. The Federal Reserve has stated that on primary residences and mostly only cash out refinances, appraisers are no longer required to actually walk through the residence. And instead, they can do what's called a drive-by appraisal. However, this could potentially lead to inflated cash out refinances, if not held in check. This was also an issue in 2008, where a lot of people were taking out cash out refinances on their homes at overinflated prices, which were severely over-leveraging their debt on that property. I don't know if this will have a huge effect this time around, since it's held to primary residences and most of it's for cash-out refinances only. However, I'd love to hear your thoughts in the comments below on how you think this might affect the market. And that's it, guys. Those are the 4 concerns I'm seeing primarily tossed around in the news these days, and 4 that I'm somewhat concerned with. However, I'd love to hear your thoughts in the comments below on whether you're concerned about those 4 or any additional concerns you have, as well as where you think the real estate market will go 6 months or a year in the future. So guys, please remember to like this video, comment below, and subscribe to my channel if you want to keep in touch and I can share with you with what I'm seeing in the marketplace, as well as I'll continue to put out content in relation to the real estate markets, personal finance, building your wealth, etc. So thank you so much, guys, and have a great day.